hand me that remote. Welcome back, everyone. Episode 117. Just moving right along. We have an unusual combination today. Our first time combo. It's myself and Tyler. We've been kind of around for a while. We're joined by Sara. Glad to have you back.
Yeah, excited to be here.
TJ.
Yeah.
So this is my first podcast with you two. So we'll see how. Hopefully, I don't mess it up for you two. So
we'll see. Hopefully, we don't mess it up for you.
We will see. We got a lot of good stuff to talk about. Markets have certainly been interesting in setting all-time highs and momentum trades and earnings season. We'll see how many subjects we actually cover today. But let's start with our two truths and a lie, like we normally do. So, like I mentioned, the S&P 500 setting an all-time high again recently. So let's quiz you guys on a little bit on maybe some two truths and a lie. A, the market cap of the S&P 500 is over 70 trillion with a T. B, after hitting all-time high, markets tend to underperform by 1% over the next year. Or C, the S&P 500 is up 5.5% in 4 days. That's a pretty good sized number. Let's start with TJ here.
Yeah,
to my
I'll kick
left.
it off.
All right.
Yeah,
what do you think?
Well, looking through the market cap of the S&P 500, over 70 trillion. When you think about some of the largest companies in the S&P 500, and they have $1 trillion market caps themselves, I think that is true. After hitting all-time highs, they tend to underperform by 1% over the next year. I don't know about that one. And then S&P is up 5.5% in the last 4 days. That might be one that you guys kind of throw the tricks in there, the 5.4% versus 5.5. But the markets the S&P has been up big in the last 4 days. So I'm going to say that A and C are true and B is the lie.
All right, Sara.
Yeah, I follow that logic. Starting with C, S&P 500 up 5.5. I think that's true. I know, Keith, you've been saying the lag 7. I think the Magnificent Seven's kind of taken their name back this week and showing out. So I think C is true. And then the market cap of S&P is over 70 trillion. I think that is true as well. So I'm gonna agree with TJ on this one and go with B.
Sounds good. Tyler?
Yeah, I mean, follow the same logic. So 70 trillion sounds about right. I mean, you could give or take a few trillion here or there.
Never know. I might be pulling a lease on you.
5.5%, that sounds right. But all-time highs, I mean, even if you invest at all-time highs, it tends to perform very well. Even if you invest at like the lows, you tend to get pretty good returns. So I'd go with B as the false.
You guys got it all right. I kind of gave you a little bit of an easier one, but you guys, I like the rationale. You guys all had it right on, because if you look at the top couple companies, and that's the way I would have done a math of quick. Okay, this company is 2 trillion.
Top 10 is probably what, 25,
30%. So
trillion at this point.
So 30 of 25 trillion,
25
maybe.
trillion somewhere in there.
It's a big number, right?
Yeah.
And then the trick on the B was, the reason it's false is there's different studies and different time periods when you look at it. But generally speaking, it's the few I saw that investing at all-time highs, markets tend to actually continue to go all-time highs. And it's actually better by the following out year by 50 basis points, roughly.
Well, we used to have a chart that was in every year how many all-time highs the market set.
I got one here a little bit, kind of. A little by decades. So we'll get to that here in a second.
Okay.
So
all right.
I
didn't look at the notes.
Does that surprise anybody? You two are newer here, but that doesn't surprise anybody. Tyler didn't look at the notes, does it? Yeah. All right. Let's talk about S&P. Tyler, we'll stick with you. So starting to get a lot of questions from advisors and clients. Obviously, the market, being up 5.5%, and Sara kind of nailed it with the Mag 7s come back a little bit and helping that number. The question we're getting is, okay, the market's been great for 3 years. Now we're on year 4. Should we be investing here, or is it, time to turn tail and run?
No, I think it's still a good time to invest, honestly. I think when you look at history, if you So I just brought up the history of all-time high investing. So RBC used to have a chart. I don't know if we still have it, but RBC did a chart of if you'd invested at all-time highs over the next 1 year, 3 year, 5 year, 10 year, and then what the difference was if you'd invested at every other time period. And you only miss out on it's like 0.5% on total return over the next 1 year, 3 year, 5 year, 10-year period on an annualized basis. So it's not just because markets that are all-time high, you have to, we've been setting all-time highs for so long.
Yeah, if you look at the chart's been up and to the right, right?
Like you have to set all-time highs to get to where we are today.
To get to all-time highs.
To get to all-time highs. So like, it's one of those things where everybody thinks that if you invest at all-time highs, 2008, dot-com bubble, 2022, 2020 is going to happen, like all of those time periods. But if you look at it, yeah, it might not be the exact appropriate moment, but again, we always talk about time in the market versus timing the market. And I think that's more important than trying to pick like, should I invest today or should I invest tomorrow?
Sure.
Right. I'm going to wait for the market to pull back 10%. We've had this discussion internally before of when you have cash, because we've done tilt series way back when we had cash for a long time.
Yeah.
And it's like, when do you get back in?
Yeah, because it gets to be a drag. And it's a tough game to, even when you're just doing a small percentage of that on your portfolio.
And because then you play the mind games of, well, I'm waiting for the pullback. I'm waiting for the pullback. I'm waiting for the pullback. And who knows when it comes.
Yeah. And if your timing's off, then it's having cash.
Yeah.
Is
so you just lose out.
Yeah. Sarah?
Yeah. Long-term investing view. And I think, I've been kind of looking at too. I don't think the market, and investors as a whole are kind of naive to the downsides either. I think I read a stat in the beginning of earnings season that, negative earnings per share surprises are getting punished more than ever. And we're seeing that, with SpaceX play out too of that CapEx spending. And then you have kind of the barbell of, revenues jumping, but investors still kind of taking a critical eye where I don't think, they're entirely being naive, to the growth or the downside, I should say, either.
Yeah. TJ, what do you think about that? Are you getting some questions or reading some stuff on that?
Yeah, one of the charts that I like was from JP Morgan. They investing at all-time highs chart, and they had put something out that since 1950, the forward returns, if you invest at an all-time high day versus investing on any random day throughout that time period, that the returns were at or slightly better on investing on all-time highs. And I think that that's because the average bull market lasts 4 to 5 years, while the average bear market is only 11 months. So if you got a bull market that's going for 4 to 5 years, which we've seen over the last, about that time period, that there's just all-time highs are just going to be more all-time highs there when you're in that bull market and that up cycle. So, and then to Tyler's point on trying to pick the random day, maybe you're waiting for a correction of 10%, but all of a sudden maybe that 10% correction comes and the news startles you so much that now all of a sudden your 10% hurdle goes to 15 or 20, and you're waiting for even a little bit more. And then a lot of the times too, the volatility is more when you have those drawdowns. So you really got to, pick your day right. And usually the best up days are usually around the best down days as well too. So
that's a good point. Do we still have that chart of if you miss out on the best 10 days in the market, your return goes from like an annualized 9% over the last 20 years, 9% annualized, versus if you miss on the best 10 days, it drops to like 6%,
5%,
something like that.
We'll have to update that one again.
If you miss 20 of the best days, it drops to like 2% annualized return.
That's why we always talk about time in the market than timing the market. Again, as smart as we think we are, and it's really hard to actually pick, because the other thing when you go to cash on something is you have to make that correct decision of moving the cash at the right time, but then also getting back in, right? So it's a two decisions,
and you become paralyzed almost. Like when you have the cash, it's like I'm just gonna wait. I'm gonna wait.
I'm shopping. I'm on sale, right?
Mm-hmm.
It's so again. So that's why I just thought we'd talk about it up front here, because all-time highs and we're there. And it's the funny thing is, the earnings season's been so strong, so that's
right.
Kind of offsetting, I think, because the valuation on the S&P 500, it's just a quick and easy one is the PE multiple, and then the PE multiple, has been around that 19 for the last 5-year kind of average. And recently, the last year and a half, it's been around 21, 22 times, which is getting a little expensive. But now with his earnings being just phenomenal, we're at 20 or sub 20 right now, which that surprises me with, as strong as the market's been, as good as they have been, the earnings have actually been really the key to driving it. So TJ, changing gears here from all-time highs to earnings season, which I think is driving the all-time highs. What are you seeing so far in earnings season? Good, bad, indifferent? Are you pleased? Are you kind of nervous Nelly, or where are we at?
Well, I think that I think right now it's been an excellent earnings season. 86% are beating estimates, and to Sarah's point, if you are missing, you are getting punished more than you typically do in historical earnings seasons. So there's a really high bar for investors, and even when some of the investors had beat, they may not have moved up as much on that day, but it seems like they're continuing to move a little bit higher. We've seen a lot of volatility in some of the Mag 7 on there. We've seen big movements from Google and Apple and Amazon. And what's new about Google and Amazon is their free cash flow went negative for the second quarter because of all the CapEx spending going into data centers, equipment, power, everything associated with that. So I think overall, I think the 9 of 11 sectors beat so far this year. So we're seeing a broadening of the sectors, and healthcare was the one biggest underperformer, and utilities is basically in line. So if you take out the utilities on there, 9 of or 10 of 11 basically in line or beating estimates, that's solid broadening out. And the other thing too is I like to see that the small and mid cap earnings as well too. I know we're focusing on the S&P 500 and hitting all-time highs there, but we've seen an inflection point in late 2025 in S&P 400 and 600, the small and mid caps there. And we're continuing to see those estimates move higher as well too. So I'm glad, good to see the broadening out outside of the S&P 500.
Yeah, that's a good point, because those mid cap names were actually negative earnings for quite a few years when large cap were driving it. So it's nice to see that starting to broaden out and those earnings coinciding. Sarah, your thoughts on kind of what you're seeing? Anything that's kind of standing out and just big picture, kind of what you're like aha moment, or this makes sense?
Yeah, no, I think, to TJ's point, I've kind of been following Alphabet and Google as well, because they, had a 24% year-over-year growth in revenue.
That's pretty big for a company that size. Think about that, right?
Wow. And Google Cloud was kind of the standout at 82% year-over-year. And I think I've seen some, analyst comments too. Is this kind of the fruits of the AI labor and kind of that super strong revenue growth? Is this kind of the catalyst that we've been waiting for to kind of see that AI, maybe just the beginning of kind of seeing how potentially that AI spend could translate into revenue growth for some of these, large powerhouse firms in the S&P?
Yeah, no, it's certainly been very good for those names. Tyler, what are your thoughts? And I'll follow up.
We've seen Google, Meta, Apple all trade down on their earnings, partly because of the spend.
Yeah.
But then the difference between like Amazon and Microsoft is they have the cloud businesses that are doing extremely well. I mean, AWS was what, 36%?
Yeah,
37.
37. Yeah.
And then Azure was 30 or 43, and then expected to be 45 this quarter, like the current quarter, which is crazy when you think about how long those businesses have been around.
These are big revenue bases. These aren't like a small cap company just hitting their growth phase. Yeah. These are big companies.
But then when you see the broadening out, like when you think about Google, so in our weekly talking points, you put a chart of Google's free cash flow. Google went negative $5.9 billion this quarter in free cash flow, which means that they had to take out $5.9 billion in loans or issue stock, one of the two.
Yeah.
Which is good for banks. So if we want to think about like financials, like the financials are the bank, like JP Morgan, Goldman, your Bank of America, your Citigroup. So those are the banks that are actually handling issuing the debt or issuing the stock for these companies. So when you think about the broadening out, it's not just tech is doing well. It's actually, you're seeing other areas of the AI trade play out, to TJ's point of the broadening out of the trade. That's where this money is flowing, is into these other sectors of industrials, financials. You could even throw out materials. Like there's a lot of other areas in the market that we haven't seen for a while because tech has been the driver, or comm services, or I mean,
Semiconductors, right?
if you want
And
to put Meta and those companies in comm services, consider
yeah,
them
we always
tech,
kind of
but,
throw them tech, right? Yeah.
so that's why you've seen those sectors do so well. But now we're starting to see other areas, which is the financials, the materials, the industrials actually benefit from this AI trade.
Yeah, that's a great point.
Yeah.
I mean, everybody thinks about the big, AI. There's different numbers. Anywhere people are saying it touches 30 to 40% of the companies in the S&P
Which
500,
is crazy.
which is a big
Yeah.
number. So, I mean, that's why you're starting to see some bear cases if you don't believe in AI, and if we're in the early innings, if we're in the late innings, that maybe that potentially is going to be a headwind for that 30, 40% that touch. But you're right. I mean, I've seen it in industrial reports, that are kind of derivative plays, like a Quanta Service had a great
Mhm.
quarter, and
Eaton.
Eaton. And yeah, to your point on banks, you don't necessarily think about banks benefiting from this, but you're right from the
I mean, we saw Blockbuster investment banking. So
Yeah.
investment
Mhm.
banking is kind of where the debt issuance and stock issuance live. So it's not just that we're seeing M&A or IPOs like SpaceX come out. It's that we're these big banks, the investment banking department is issuing these bonds and stock for these companies.
Yeah, what's encouraging to me for the overall earnings season so far, we're like probably about 70% after, midway through this week. We're 61% as of last week. And like TJ mentioned, big beats. I think their earnings year over year are 47% growth in Q2. That's just
Yeah.
a crazy number. And then the forecasts this year are still holding at 24%. I think they're going to be inching up a little bit to maybe 25, 26% for the full year. And that's really good. And then the reason I'm talking about the earnings growth so much is because it's what you pay for a stock, the valuation, the PE multiple. And that's why the overall S&P 500 now trades at 20 or sub 20 times, because earnings have been so good. And technology, there's a chart that Goldman put out too that talks about tech's kind of struggled here a little bit in July, but the earnings, generally speaking, have been great. Especially some of these semiconductors are just they're growing 100. 150%. So then the multiple actually goes down.
Yeah.
The earnings are there. So
No, I do think there is areas of caution.
You and
I've
for
talked
sure,
about this a little bit, not on the podcast, but when we think about the semiconductors or even just the hyperscalers, there's a lot of circular finance going on right now where they're counting revenue that's not necessarily revenue
yeah.
because of the investments. So you're seeing paper revenue. And some of the companies are changing their depreciation schedules from 3 years to 5 years, which lowers their expenses. So you're seeing inflated revenue plus you're seeing inflated earnings because less expense. At some point that comes due.
Yeah.
Where these companies aren't going to see this 30, 40% revenue growth plus 35, 45% earnings growth because they have to account for the non-revenue that they may have not been getting. So there is some concerns, I think, especially in the semi space when you're talking about these different investments that companies are making.
They become cyclical
into each other and all of that.
Yeah.
So I think there is a little bit of concern there, especially on the semis, which you and I have discussed on the podcast before, of not wanting to get too heavy into semis. But I think the revenue growth rate, the earnings growth rate, I think maybe a bit inflated.
Yeah.
From what
you saw a little nervousness in July, I think, on those semis,
Mhm.
and they were up over 100% year to date, roughly the whole index, and then they corrected about 25% in July. So I think some people are just kind of like, okay, it's great, but are we getting to
let's take some air out of the
we get into peak margins, peak growth rates, and then
Yeah.
you start going down the second derivative stuff, and then you start doing a little bit more analysis, and there could be some reasons for hesitation. So, all right, we'll change gears one more time here. I thought, again, I'm the old guy here in the group. I've been doing this a long time, but there was a story a week ago of the momentum trade, and that was kind of by situational awareness fund by, was it Leopold Ashbrenner? I think is how you pronounce his name. Brenner.
Is he the
He was the open AI guy. He's
yeah,
24-year-old.
started his own hedge fund.
Started his own hedge
Yeah.
fund basically at zero. He got some capital because he is like an AI guru, supposedly.
Yeah.
Obviously is. But he quickly had a $10 billion fund, levered it up. It was $45 billion. And I think the returns I saw last year were like 500%. So who doesn't want to be with someone that's returning 500%, right? So I'm sure he was attracting investors all over the place. But he had a lot of leverage bets on AI, and these memory chips and some stuff
July
like that.
crushed him.
July, literally, how quickly things can turn. His 45 billion got wiped out in just the month of July. Think about that. That's not how we run money, but I thought that was just an interesting story.
Didn't Goldman buy him out?
No, Citadel.
Citadel
Ken Griffin.
bought him out.
Sarah, did you get able to follow the story at all, or were you a little bit too busy in Canada last week?
I didn't follow this one too closely, but I mean, look, you go back to the principles of investing and diversification, and I think I'm kind of, starting to think through that further of, AI is great, but where can you diversify even within the AI play of kind of sub-markets and that small and mid cap too? I mean, who ultimately are going to be, the beneficiaries of this, trade and kind of diversifying away from the semis. And I think you can go, pretty far in diversification, even within AI to kind of, take all your eggs and put them in different baskets.
For sure. That's well said. TJ, you got any thoughts on that story and kind of what your takeaway was?
Yeah. Well, that came on the first podcast and talked about leverage. I did not foresee that we would have a huge
nice call to you. We'll have to get out the tapes, TJ.
Yeah. I didn't forecast. I didn't see that one coming there, but that is what happens with the leverage on there. You're 4 times levered up, and if you have a 25% drawdown in your portfolio, I mean that takes you out and wipes you out. And when you get margin called on there, it's my understanding is that it's an automatic process, and you kind of get things forced sold for you, and that's what you never want to be, is a forced seller, because essentially you turn your unrealized gains and you crystallize them and you turn them into realized gains there with that. So I think that's just another thing for investors to keep in the back of their mind is, just it looks attractive to your point when you're seeing the 600% returns, but then when you can completely get wiped out in 1 month, that's the other side of the coin there with that. So
could you imagine? Excited. Yeah, could you imagine our clientele that are kind of pre-retirement to retirement? You're like, what? You just had $1 million, now I got nothing.
Yeah,
that would be a tough,
bad scenario.
Yeah, we don't play that game. Momentum trade, though, let's just talk about that in general. Like, there's different studies that are out on different factor investing, and one thing that's surprising, I'm a growth guy. I've been doing that for 30 years, and that's kind of my background. That's kind of how I invest. And there's you can do GARP, you can do momentum, different things. But which little surprised me is I saw a study, 6 months ago saying momentum trading has actually been the best factor over the long period of time. Only problem is the volatility. You get to this situation where it's great when it's going up, then it reverses and it just absolutely destroys people. And the problem, for our investor base, generally speaking, is they're a little more conservative. They don't want to take that downside risk when it happens. So that's just the one thing we have to be careful in momentum investing. But I thought it was interesting because, so basically that 45 billion he had was all AI leveraged stuff like SanDisk and Micron and different derivative plays on AI got wiped out. And what I find fascinating is Citadel, one of the hugest hedge funds out there, and Ken Griffin has been, he's probably older than I am, at least probably close to it. He's been doing it forever, right? And he seems to have about 6 more, 8 more zeros behind his name than I have. But anyway, hundreds of billions is what he owns or has his net worth. He's the type of investor, I think, that, kind of makes these big bets and kind of can see things that when they're turning. And literally the night of, the morning of, they signed their deal of him basically buying those assets on the cheap, even discounted to where the market was. That morning when the market opened up, those positions unwind. And that's what it's kind of like. I was talking to a couple of our media guys who were asking about the story, and they're like, well, I was reading here and it's like, like blood in the water. What does that mean? What was going on? So what ends up happening in these hedge fund world is everybody knows generally what books and names are traveling in. And so when they knew the unwind was happening, they knew this guy was long such positions, people were betting against him, so they're taking shorts, right? So they kind of pressuring him and dropping it down. And then at some point, the banks, like Tyler mentioned, not only do they do the stuff for your trading, but they also borrow you money at margins. They basically say, hey, tap you on the shoulder, hey, buddy, you need to sell your positions because we want our money back. And that even you may not want to, if you could just wait another week, month, 6 months, you'd be fine. But when you lever up that much,
well, have you ever seen the show Billions?
Yeah, it's a good show.
Right. So like that's
kind of the game.
Kind of the hedge fund game. So like if you ever watch Billions, there's I can't
It's a
remember
good show
exactly
for
what.
if you're was on Showtime and it's on
Yeah, I think it's on
some other
HBO
thing.
Max.
Yeah.
But I think there was one position where they knew XYZ hedge fund or guy was in it, and so they were shorting the crap out of it
Yeah.
just to try and make it go down.
Yeah.
Just to go against him, right?
Yeah.
Like there's games that these hedge funds and
It's
institutional
another whole
investors
level.
play.
Yeah. But that's the point of the whole thing. It's just another whole level of things that we were fundamental investors. When we buy a company, we're not betting on Tom Jones next door, being long this or short that and kind of driving the price up. But they have such big books. And that's why you can see why 45 billion to zero in a matter of a month is crazy. But anyway, since that trade got unwound, momentum indexed up like 27% in 4 days. It's crazy. Now, prior to that,
So here's my question to you then: was Citadel betting against the
against
whatever it is,
situational
awareness?
Oh, I'm sure they were.
say-
Yeah, part of the way down, and then they changed
Right.
their position, right? And then because that morning, literally the morning of the open, when this news was breaking, and again, if you're in that realm of my old job, I used to call it the weasel wire, kind of the hedge fund kind of talk, and I was far enough out of it that the stuff I was always getting was kind of like kind of questionable. Like I'm gonna tell that guy over in Minneapolis this when we're doing that type of thing. When you would hear these stories, I never traded on them or anything like that, but it was always interesting to hear these kind of in the know. But mine was second, third hand. We don't even get that stuff now, so it's an interesting game. You really have to be dialed in, connected, and it's like if you watch a show like Billions, that stuff really does happen.
Yeah.
So, point being is momentum is fun when it's working, but when it cuts against you, it's certainly a little painful because momentum was down. That other end of July, which there's an index out there that follows momentum. One index is down 40% in 4 days, and that's probably some of those names like the Micron, SanDisk. Again, they're up 150% in a matter of 6 months. Okay, they have
SanDisk is like 800.
Yeah, 800%. Yeah, so you have a drawdown of 30-40%. It's like, okay, as long as you didn't buy at the high, you're probably
still probably sitting fine.
Still in pretty good shape. So that's why I thought it's a little good lesson to learn about momentum investing and kind of.
We did talk about the leverage stuff too a couple weeks ago.
Yeah,
I mean
that contributes to it, right?
When you're at all-time highs and you get a downdraft of 4 days, like that leverage can. Obviously, $45 billion to. I don't think he finished at zero, but
I mean, you can get pretty close.
Pretty close. I mean, leverage just kills you on the downside.
Sara or TJ, have you guys either dabbled in on your own personal accounts on any of these leverage ETFs?
I have not personally. No.
Sarah?
No, I have not.
All right, it's probably good. Tyler and I maybe a little once in a while. And sometimes
it's not fun.
Yeah,
especially when they break.
Yeah, they can quickly go against you and quickly work for you. They should be, if you do it, make sure it's relatively small and you can afford to lose whatever you're playing with there, and make sure your trades are very short and concise. And the longer they typically go on with these leverage ETFs, just so you guys know, the more the math works against you. Even if you have a right call, it doesn't seem to pay off. So most investors, anybody listening to the show, probably shouldn't be playing that. The big warning block letters there. So, all right, let's get some random thoughts. Sara was just in Canada for a week. Why don't you give me a little rundown? How was Canada? How's the economy? Could you tell how the economy was in the area you were? Was it good, bad? People seem to be in good spirits. Well, how was Canada?
It was good. Yeah, so I was in the Banff area, a lot of travel, a lot of actually international, workers. I talked to a few of them. It sounds like, getting a 2-year visa from Europe or Australia, a lot of folks were from, was fairly easy. So yeah, a lot of international workers in the area that I was in, and yeah, travel was booming, and Lake Louise was busy. A friend said I think they get 20,000 in there a day.
What?
Wow.
People?
The
shuttles, it was crazy.
Is the airport close to that area? Or not
An
really?
hour and a half from the Calgary airport.
Okay.
So that's how many people are, coming in to see Banff. And yeah, it was great. Mountains and wildlife, and did some hiking, and yeah, just good time we had a wedding out there. So good time with friends, and then we kind of went off on our own and off the grid. I was saying not much service, so it was a different change of pace for sure to not really have not be plugged in too much. But yeah, it was great.
Yeah, the pictures you showed me is like looks like a fake. They're
Yeah.
just so beautiful.
Highly recommend going. It was easy. Yeah.
Yeah, we had Grady had an event there, I think,
Mhm.
before Tyler and I started, and everybody still raves about that outing
Yeah.
because it was, I guess, it's good as what you
Yeah.
said it is. So,
It's great.
but it was busy though, right? I mean,
Yeah.
the people are still spending and work
Yep.
going out, and
Well, so we went to Quebec 2 years ago.
yeah, year and a
year
half, whatever that would have. Well, not this year, but a year ago.
last year.
Yeah, last year.
And it was right when the tariffs kind of hit, so like you
Mm.
couldn't get whiskey.
Whiskey, the U.S. Yeah,
like they're boycotting the whiskey. So like at the bars, they were like, "Yeah, we've got one bottle left."
yeah, and they're holding you hostage on the
Running
price
low.
of it if you give us what.
So I was curious if you noticed any of that.
No, not really. I mean, the dollar
I don't know if you
went.
drink whiskey or not.
Yeah.
Yeah, no, we didn't get into the whiskey, but didn't kind of notice that from the tariffs. But the dollar kind of went further than I thought it would with a Canadian.
Oh, did it?
Yeah. So that played in our benefit, and
Nice.
things were a bit cheaper, so that's always nice.
I assume the prices as a whole weren't cheap in that kind of resort area, are they?
It was probably less than we would pay here for like a
Really?
drink.
Oh.
Yeah.
Oh,
So
wow.
Sounds like
Tyler,
we go to Banff.
Yeah.
Good to go.
New destination.
Yeah. TJ, you've been fishing a little bit lately. You
Yeah.
know, anything going on there, or what have you been up to this summer?
Yeah, getting out on the water a little bit, which has been nice. It's been extremely hot, so getting out on the water is always a good time. Get some sun in there. But yeah, the Canada store, I went up there the past few years, and it's just absolutely beautiful up there. And the thing that I like the most about it is it's all natural in the way it's been since the beginning of the time. For the most part, the lake that I went on to, there'd be a couple resorts, but for the whole 99.9% of the lake, all natural shoreline,
Yeah.
rocks, everything there. So I can attest to Canada being a beautiful place there. The couple of times that I went there, but yeah, me and my brother have been bouncing around a little bit on a few lakes. We haven't got out. We're primarily muskie fishermen, but when the water,
wow, that takes a lot. You don't get too many muskies, do you?
no, it's a lot of work for very little fish. Yeah, a lot of people kind of call some of the muskie guys a little crazy, but you kind of progress through your life of fishing and got hooked on that. But when the water temps are really high like this, and you start to get above the 80s and in the mid 80s, ideally you don't want to fish for them at all, because of the high water temps can mess with the fish, and it causes excess deaths basically
Really?
on there. So those few weeks held back a little bit, but on a couple of the nicer days got out, and yeah, it was
Good for
beautiful.
you.
Yeah.
Well, I guess those methods so far is, from Tyler, Sarah, and TJ, and myself, and Canada, we're still your friends. We
Yeah.
still enjoy coming.
Yeah.
So don't be afraid to come down here either. Tyler, what have you been up to this summer?
Not a lot. Got up to the cabin a couple times. Actually, talking about muskie fishing.
Nice.
So the lake that my parents' cabin is on is known for muskies.
Oh, okay.
Oh, don't give
Okay.
TJ the address.
Yeah.
So
You gotta tell me the
Can
lake
have a
name.
visitor.
the last time I was up there, I was teaching the boys how to fish, and so I had like the little tiny rod for Hudson, and I had just like the little tiny hook on
Yeah.
it, and we were doing whatever. And I had casted a few with my rod a couple times before just to play around, see if I could catch anything. And also, I've got Hudson's little rod, and probably like a 3-foot muskie came swimming by the dock. And so I'm sitting there with Hudson's like little tiny.
Trying to.
And I'm trying to like get. So I like rush back to the cabin, grab my rod with the muskie hooks on it, and by then he was gone. But I was like, oh,
Oh.
no.
That's always super cool when you
But
see
yeah, it was it's a big fish.
Too much that you freaked out. I'm sure your son's like,
Yeah, and Hudson's like, oh,
Dad,
what
it's about
is
as big
that?
as I am.
Yeah.
It's like a shark.
Yeah.
So, anyways, but yeah, just normal backyard shenanigans.
That's good. Yeah, I haven't. Same thing, just kind of normal stuff. But then I was complaining before I came in here is we got new iPhones for our family. Just they're 13, 14, whatever. They're old. They're 3-4 years. We don't update them that often. But one of the kids had a problem, so we're all updating them. Seems like they're backing up, getting all their stuff done in about an hour or two, and then comes to my phone, and I don't know what it was the deal. It took me about a day and a half to get it up. So I'm starting to show my. I'm not a boomer, but
Getting
geez,
old.
I'm starting to fall into that camp. It was just a nightmare. It was just like backing up stuff and iOS systems and this and that. And anyway, phone companies don't
Pay
make it
for
easy.
more storage.
Oh, 100%.
and
It's
Always
like-
some subscription now.
I'm already an Apple One. Now they want more. It's like,
Yeah.
I don't know, family share. It's like, dudes, how much you need
Once you
from
get
me?
wrapped into the
No.
ecosystem.
the subscription model.
Subscription model, I guess that's a good point. So any companies that we invest in have a good subscription model is probably not a bad place to be, because you get guys like me that just keep paying them, and then there's guys like Tyler who probably have subscriptions that you don't know you didn't turn off, which I think I just got my Minnesota Wild
I
I just
actually-
discovered this week too.
I actually went through my app store on the subscriptions to figure out what I was paying for that I didn't realize, and there was so much stuff that I had to unsubscribe from.
So that's another FYI, or a little shout out, a PSA for anybody listening, is go through your subscriptions and turn off the ones you don't need. So.
Right.
Well, like for the World Cup, like I subscribed to Fox 1 just
Yeah.
to watch the World Cup, and I watched maybe like a game and a half,
Yep.
and I still had it.
Yeah.
I was like, I'm paying $20 a month for this,
Yeah, I think
or the
I'm-
Wild, the FanDuel
I-
Sports.
I think I'm on that Fubu or whatever it is that to
Yeah,
watch
finally
it.
I'm
Right?
Don't
subscribe
get me
from
started
that.
on the Wild.
Yeah.
It's so tough to watch a game now.
It is.
They-
I think they
It's-
changed up how you watch the Timberwolves this year as well too. I was hearing some people give a lot of pushback against that, because you'd have to get a subscription to watch your local team.
We're supposed to be the state of hockey, and you can't watch it.
Yeah.
All right, everyone, like and subscribe.